Good evening, everybody, and welcome to, would you believe it, the 5th in our series of 6 events where we've looked at turning the startup journey on its head, started with exit, and we're now back to fundraising and pitching. And we've got 2 excellent speakers here, and we've got a bonus speaker as well. So we have Susan Elliott from the British Business Bank, who's going to be joining us for the Q&A session. We're going to say a bit about the British Business Bank. We're going to start off with Benjamin Storey, who is a person who organises Eagle Labs for Barclays and knows an awful lot about fundraising. And followed by Richard Cooper from Oxford Innovation Finance. And I'm sure Richard will tell you all about the angel networks and the fund that Oxford Innovation Finance has. So there's lots of information here for you, and without further ado, I'll hand over to Benjamin.
Good afternoon, everybody. I am Benjamin Storey. As when you kindly introduced me, I'm a key client, industry and performance lead at within Barclays Bank. I feel like I've done something wrong already. Everyone's left. And part of the Eagle Labs team, who essentially are here to help early stage companies to grow and scale. I'm going to very briefly touch on these 4 subjects today. So grant funding, crowdfunding. I'm going to have a very loose touch on equity funding because that's what Richard's going to speak about. And we're going to talk about debt and debt suitability for early stage companies to use debt as a mechanism to grow. Before I talk about anything, I think there's a couple of things everyone needs to be aware of, obviously looking at your first raise or looking to grow your company. I think the first thing is that no journey is the same for you as the people next to you, okay? You need to understand that what is right for your business is not necessarily what is always, it's not always the conventional way. And so do listen and learn and see some of the things we're going to talk about, but don't treat this as the way you should do what you should be doing. Second thing is I'm here in a non-advisory capacity, so literally here to talk about hints, tips, tricks, just things that you should be maybe aware of. But I'm always happy to support companies if you want to get in touch, but I can't tell you what to do. That's for you to find out the answers for yourself. Okay, so I'm going to race through these because I know time is precious. So grant funding. Don't bore yourself with reading what's on there. So there's more notes for me. So obviously, large provider of grants in the UK is Innovate UK. Innovate UK is one of 9 funding councils that sit within the UKRI, so UK Research and Innovation. So I think most people, when they think of grants, it's free money. Isn't it as simple as that? They usually link what their competitions are linked to ISCF, so Industrial Strategy Challenge Funds. People think you get money up front. That's not always true. So about just under 5% of grants are actually paid up front. About 30% are matched. So you've got to find the money, whatever you're doing. If you're going and get £1 million, you need to maybe find the match capital as well. And then about the majority of them are spend and claim back, i.e. you need to have the capital, the cash flow to be able to spend the money to then be able to claim it back if it's approved. Old data, apologies, this isn't as up to date as I wanted it to be, but about £6 billion a year back in 2019 was spent. I know that's higher now, but I don't have an accurate number for you. I've listed there also some of the other councils and bodies that do grants. So Innovate UK is the biggest one, but doesn't mean that you may not have something that's relevant in those other departments. If Innovate UK don't have the competitions that are relevant for you and you may be solving maybe a slightly smaller problem or a more localised problem, I'd recommend speaking to someone like your LEP, or if you live in London, a LEAP. There's 38 of these around the UK, and they will often have specialisms or focuses themselves, but it doesn't mean they don't actually run things that you can access in terms of grant capital to help progress your ideas. Beyond the LEPs and the LEAPs, there are other providers of grants such as corporates and sovereign funds as well. And if you're doing something maybe more charitable or it doesn't have to be necessarily a business idea, but you can also obtain grant capital through the lottery, who are quite a big funder of grant capital. Lots of people always ask me, what's the process of actually accessing this? It's not as simple as I just send an application in and they grant it and they pay you. So I've actually been through the process myself. I was lucky enough to win a grant a few years ago, pre-pandemic, and the process is pretty rigid, not going to lie. There may be some slight variation depending on the program, but you're usually going to have to follow this 6-step process. So obviously there's an online application. I think Innovate UK specifically gets something like 85 applications on average for one grant that they actually approve. So it's quite competitive. Don't be afraid by that though, because there's a lot of duds in there, I believe. There's a lot of people who are applying for coffee machines and not for innovation capital. After you've done your submission, you'll be invited to a panel assessment if you've been one of the approved ones. So again, they won't approve everybody, but that's the next stage. That may follow with a face-to-face or a video interview and a little bit of understanding more about the business, your aspirations, where you're actually going to get to. Then they'll announce you as a winner, and then actually you start the real investigation into your business, which is the contracting stage. You need to prove a lot about your business, about some of the things you've maybe said in your application, and you have to prove you're eligible. I'm going to touch on one of the biggest eligibility pieces that people don't know about, and then you get your money paid. Key tricks and tips that I think is always good to know about when you're doing an application. When you're writing an application, you need to remember that these are government monies and they want to see how government's getting their return on investment. So the key mistake you could make is not demonstrating value created, either in terms of return on investment for the taxpayer or the government. So ROI for the government is going to be either jobs created, or which is essentially getting tax back into government pockets, or revenues, and again they're getting taxed on that, aren't they? Again, people just don't answer the questions. When I used to speak with Innovate UK very regularly, the amount of people who just don't answer the questions, they want to say what they want to say about their business as opposed to answering the question. And then the last one is not checking the eligibility criteria. I say really competitive, but the amount of companies that don't meet the state aid eligibility criteria is actually quite significant. Now, just going to touch on state aid very quickly. What is state aid? Long list there about the qualification of state aid as of, I think it was 2020. The one I've put in stars there, very amateurishly, is one that people don't actually notice. You cannot have lost more than 50% of your share capital through losses over the since you've set up the business, and still be eligible for an Innovate UK grant or a grant in general. Which, if you're doing something innovative and you've set up a company and you've really invested R&D into it, it's worth knowing before you apply, because it's a waste of time applying if you're not eligible for it. Anyway. And then the last slide on grants very quickly is what are the key things that grant providers are looking for. So I've listed here unique technology. Ultimately, I think the clue is in the company. So Innovate UK, they're looking for something innovative. UKRI, looking for research innovation. And so something maybe technology, often IP defensible, that's part of one of the assessment questions. If you can solve a national problem or a universal problem, if you've got a problem you're trying to solve like traffic in Birmingham, you're not likely to win it. It wants to be something that can have scale. It needs to have a commercial business plan. Always a strength if you've got partnerships with universities or with other research collaborators. If you can align it with an ISC, so an Industrial Strategy Challenge, you've probably got a stronger chance of being successful, because that's where they want to put most of their monies. And then you need to be a UK registered business. So again, it's a trick it's a clue in the provider, but they're looking for UK companies. And UK definition is either trading 50% of revenue or 50% of your staff based here full time. And then last point there on grants is they love to make sure they spread the capital around the UK. So if you're outside of London, you've probably got a better chance maybe in it, because they want to demonstrate one of their KPIs is they want to show that they're spreading the capital around the UK. Okay. Very quickly going to touch on crowdfunding. Crowdfunding, I think most people have probably heard of it, and you've probably heard some fantastic stories about people like Brewdog. Crowdfunding, you need to determine whether or not it's the right thing for you. So some benefits of crowdfunding are you can get good market exposure quite quickly. You de-risk it in terms of having some founders who might have quite significant investors that might have significant stakes, and you don't have to necessarily do lots of time-consuming pitches and go speak to hundreds or tens or dozens of investors. You can maybe just do the one on your one platform. Considerations that you should have when thinking about whether you're going to do a crowdfunding campaign. Imagine trying to solve for dealing with 1,000 investors at a time, or so you need to think about your investor relations. If you think that's going to be a concern, maybe think twice about crowdfunding. Often you'll need to finish the crowdfunding campaign in order to access the capital. I don't know if the rules have changed on that, but that used to be a hard rule a few years ago. There is a cost to crowdfunding. I'm not saying there's not a cost to equity, but I'm sure Richard may touch on that later. And you're dealing with a relatively unsophisticated investor base. So language in what you're writing. If you've got a very technical product, don't expect the unsophisticated investor base necessarily to understand to the depth of what you do. So always think about, if you've got a technology-heavy business, is this going to be the appropriate investor base for you? There's 5 types of crowdfunding. The 3 key ones are reward, donation, and equity. I put some examples on there. I think most businesses may be looking on the equity side, but it doesn't mean that you can't be looking on something like a reward basis. And then the other 2 at the bottom, lending and ICOs. Lending is, there's other parties that will do sort of, where you can do some swaps, things like Zopa and RateSetter, ones you may wish to consider. And then an ICO, initial coin offering, is essentially a blockchain version of an IPO, but another way in which you can crowdfund. Just finishing this off, there's some very popular sites there, depending on, usually the sites differ depending on what you're looking to achieve. So equity, you might be looking at Seedrs, Crowdcube, Syndicate Room, etc. Rewards, Indiegogo, Crowdfunder. A nice resource actually I came across a few years ago, if ever you're wondering about how to value your business, because I think valuation is not necessarily a hard and fast rules. And if you don't speak to investors and really get to how you're valuing your business, something called Equidam, good resource, free resource. You can go on, it'll help you maybe make an assessment on what a good looking valuation for your business may be. I'm not going to touch on the equity side too much. The only thing I'm going to say is, because I think this is one of the learns, I spend a lot of time with investors, and when I'm asking those investors, well, what are the key things you're looking for, some of the guys have said to me, here's the 5 risks of our investments. So execution risk, so can the team deliver? Will your team deliver what you're saying it's going to be? What are the strengths and weaknesses of your team? Market risk, is there the demand for the product? Is there enough customer demand? What proof points have you got to prove that and validate that? There's a product or a tech risk. Is the tech going to work? Is the product going to do what it's going to say it's going to do? Is it protected? Is it protectable in terms of IP? What problems could it face? There's going to be a business model risk. So will the business return money? Will it make the claims? Will it return and make a business? And there's the return risk for an investor. Will they get back not only the money they put into it, but the profits they want to make out, or the 10x's they want to make out as well. What barriers are there going to be for them getting their money back? But I'll leave equity for Richard, who's obviously a specialist in this space. And my last couple of slides are about debt. Lots of people come and ask us about debt. Is debt suitable for early stage companies in terms of growth capital? I'm not saying it's a no, but generally no. It's not a no, but generally no. The 2 key reasons is affordability and security. From a bank's perspective, I'm not saying you can't obtain these, but for very early stage companies who either don't have the cash flow, they're probably unlikely to have the affordability to repay the debt, and therefore you're probably going to fall foul of being able to get cash, a debt facility there. And then security, again, some lenders will lend against IP, so that there's maybe specialists, but ordinarily security, we're looking for something more hard and fast to take a charge on, so it could be premises. Again, early stage companies, not saying you don't have them, but it's not common to invest in physical, infrastructure or capital expense instead of investing in technology if you're a technology company. So it's not a hard no, but it's not something you see very commonly for very early stage companies. And then the last thing I was asked us to speak about very quickly was what support can Barclays and Eagle Labs in particular provide to support companies going through if you're looking to raise capital. So in terms of an education piece, you'd be pleased to hear that I don't do the speaking on the capital raising education piece. It's run by a partner called Capital Enterprise. So they run our funding readiness program. It serves about 1,200 companies a year, helping companies to understand about equity, crowd, and grant capital in far better detail than I've spoken about today. If you're looking for access to markets or talent or even capital internationally, we're on Global Connect programs, which actually help take companies who are looking to raise significant capital over to places like San Francisco or to Singapore or other places where there's markets and capital available. Demo directory is something which has been live for about 15 months. Its aim is to simply connect founders and investors. It's a free to access platform which enables a founder to demo freely to, I think there's just over 250 investors on them at the moment, but constantly growing. If you want to be involved in some of our demo days, the very oddly called Eagle's Lair, it doesn't sound anything like the Dragon's Den. We do demo days and they're usually, say, themed by sector. And then if you want further support beyond capital raising, so we have mentors with people like Cambridge Judge Business School, Accelerate Her, Commonwealth Ventures, one of our partners over in San Francisco. If you want support, we can provide you mentors, again, free to access mentors. If you want further breadth of support that isn't necessarily about capital raising, we have other propositions you may want to check we've got quite a lot, but I've just listed here a couple, such as Black Founders Accelerator or Female Founders Program. And we have industry leads as well who are there to support you in different areas. So I've tried to race through that as quick as I can, Wendy. Hopefully it has made sense. Any questions, either drop me an email or go onto our website, labs.uk. But I'll hand over to Richard.
Thank you very much, Benjamin.
Yeah, thank you, Benjamin, and hopefully not stolen too much of my time on that equities section. Nice to see everyone today. Yeah, as Wendy said, my name's Richard Cooper. I'm the Managing Director for Oxford Innovation Finance. And for those that don't know Oxford Innovation, we do three major things. We run innovation centres, so we've got 28 around the country. So we are a national organisation, not just in Oxford. We also do Oxford Innovation Advice, and that is to give support to companies who are scaling and starting up. So they run various programs, including the Innovate UK Edge program in the Southeast, the Manufacturing Growth program, and quite a few others. But I guess the most important thing for this conversation is Oxford Innovation Finance. So once you're growing your business, probably the next port of call is to raise some money to really scale it to the size you want it to be. And traditionally, we've always been an angel investment network. So we're probably I think we definitely are the oldest, but probably the largest angel investment network in the country. And also, more recently, we've started running a fund. It's called the Oxford Innovation EIS Growth Fund. And we're on the second fund at the moment. So last year, we invested in 9 companies. And the difference between the angel network and the fund is the angel network's made up of active investors, and the Oxford Innovation Growth Fund, they want us to invest for them. So that's more of a passive investors. So let's look at the type of angel investors. I'm going to talk today about types of equity finance, what it is they're looking for, what it takes to raise the money, and quite a few common mistakes I see. I've been doing equity fundraising for 20 years. I've raised equity for my own companies as well. And there is a nuance to it. You shouldn't raise equity funding too many times, so it's quite new to most people. So I'm going to try and describe that as much as possible. I'll try and make it as interactive as possible so not everyone falls asleep. So get ready to answer some questions. Wendy might have to come with a mic if she might not be able to hear. So angel investors, what are they? I mean, angel investors are high net worth individuals who tend to want to put money back into companies. Quite often they're retirees who've done very well in industry, and they want to invest in companies who are the future of the UK economy or global economy. And what type of return do you think they're looking for? Any answers to that? A 10x, thank you very much. 10x return, and why do you think they're looking for a 10x return?
Probably more, but because it's high risk.
Exactly, it's high risk. That's a very good answer. I mean, the reason everyone's looking for a 10x return is most of the companies will fail. The majority of the companies will fail in the scale-up journey. So usually what happens is five of the companies they'll invest in will fail. 3 or 4 will do okay, and 1 will make that 10x return, covering all the rest of the money. But everyone looks like the 10x to begin with. Okay. So that's what angel investors have to do. They're very passionate about the companies. They add a lot of value, and they usually help unlock doors for those companies who take on angel investors. I'll add a caveat. Every company is different, every investor is different, so it might not always be the case. Crowdfunding, Benjamin talked about a lot. As he said, crowdfunding's a very good way of fundraising if your product or service is easy to understand. We invest in science, technology, and innovation, and those type of companies don't tend to do too well on crowdfunding because you have to be able to understand it so quickly. And if you can't, and the mums and dads out there who are invested in crowdfunding don't understand it, they're not going to invest. And And the last group is, like I described earlier with our fund, is the SEIS and EIS funds. Now, the advantage of funds is the money's committed. Angel investors don't have to invest. They invest for the passion of it. And I'll talk about that a bit later. Funds, they've already committed the money. The funds have to get that money away, usually within that financial year. Okay? The reason they have to get rid of the money in the financial year is for tax reasons. And the UK government have very nicely given tax incentives for investors investing in early stage companies. They're called SEIS and EIS, so Seed Enterprise Investment Scheme and Enterprise Investment Scheme. So the benefits of that is the investor will get a income tax reduction. It's 50% for SEIS and 30% for EIS. And I could go on about that, but I won't today. But it's very beneficial because there's something to help and encourage investors to look at this space rather than looking at the general stock market or putting their money in savings. Okay, Benjamin briefly mentioned this, but what do you think? I'll put it out to the crowd in the room. What do you think investors are looking for? Just hands up. Return, yeah.
Team.
Good team, very good one.
Ideas, technology, innovation.
Yeah.
Well, it's the same thing. I look for good people. Market traction.
Yeah. Okay. Now this is not a hard and fast rule. I'm going to put the list up now. It's not a hard and fast rule. The sectors are different, so just remember that. But generally, don't be scared, by the way, if you don't cover all of these. No company we've invested in covers all of these, but it helps if you've got quite a few of them. So, is it a disruptive innovation with a strong value proposition? If you're going into a market and you've spotted something from your experience, and that will disrupt that market and help with a strong value proposition, then it's a big plus. If you understand that market. The next four you can probably put together because it's really about once you've got that product, will it make a return? We talked about that. Is there a high margin? Will the rate of growth be there? And can you scale quickly? No major barriers to growth. So I'll give you an example. If your only customer is the UK public sector, for instance, the NHS, then I would call that a barrier to growth because they move slowly. They're not used to dealing with startups generally. That type of thing would put investors off. So they might say to you, could you go to the private sector? Could you look in the US, for instance? Repeatable sales and distribution model. If you can repeat sales, it's a lot easier for the investor to predict where you're going in the future. So if you've got recurring revenue, the reason everyone talks about recurring revenue is easier to predict than believing that your forecasts are definitely going to work. Obviously, a large total addressable market would be fantastic if it's absolutely massive. I tend to look at it when I'm looking at investment opportunities. Actually, what are you going to tackle in the next 12 months? That's probably more important to me than the size of the market. If you've got innovation that's defensible, fantastic. Some people have to go for speed to market because it's not defensible. If you're going for speed, how much money will you need to attack the market quick enough not to be copied? And the most important, which we've got a few people have pointed this out, superb management team and advisory board. And the reason for that is that all startups and scale-ups will hit a bump in the road, and it's adapting to that bump that is the most important thing. And when we invest in companies, I see a lot, when the management team adapts and brings in people to help them, they're the ones that go on to do great things. And sometimes you will see a management team go, "Ooh, we've hit a bump, I'll give up," which is what we're not looking for. So that's what investors are looking for. So in terms of the process that generally happens, one of the most important things when you're connecting with equity investors is there's always someone stopping you connecting with the high net worth directly. And they don't want to be contacted directly. They want someone, an angel network or a crowdfunding platform, to filter the opportunities for them. So you need to have an initial discussion with an angel network manager or the head of the crowdfunding platform and have that initial discussion and information exchange. It's absolutely key that you're prepared before you do that. The equity market in the UK isn't that big. So if you go in half-hearted and go, I don't really know what I'm doing, there's no information behind what I've got, I'm just going to go for it, it won't go down too well, because the competition that you're fighting against for the pitching event, for instance, is pretty harsh. So you've got to be prepared. There's plenty of help you can get. Innovation directors within innovation centres such as this, they can certainly help you. The Innovate UK Edge programme, they can help you prepare all this. So you're definitely ready to go and have those initial discussions. Then hopefully you get selected to pitch in front of investors. Make sure you practice and practice and practice and get your pitch right. The timescales are usually anything from 3 to 10 minutes. We do 5R showcases, but it does vary. And essentially what you're looking for is to get that follow-on meeting. Don't, when you're doing a 5-minute or 3-minute pitch, think you're going to get investment straight off the back of it. What you're trying to do is get them to that next meeting. Then you negotiate terms, you get the information ready, and you sign term sheet and the money in the bank. Now that process can be as little as 3 months. It can take longer than that. It can be six months. What I would say is I've never seen it delayed by the investors. It's always delayed because the company is not quite ready, hasn't done all the information. So just bear that in mind. If you've got everything prepared, you can get it done pretty quickly. Okay, what to include in a pitch? So the pitch deck's pretty important because it will be the first opportunity an investor gets to see you. Okay, and what they're judging is not only what's in your pitch deck, they're judging you presenting that pitch deck. Okay, and one of the most important things I like to hear is certainly why you started the business. And if you say to me, I started the business because I saw X, Y, Z in this market, and there's a big gap, and this is why I'm doing it. Nice. So that's what we would like to hear. Obviously, what the company does. Don't go on about what the company does for your whole 5 minutes. Be wary of that one. Why does it do it? What's the problem and the solution? And why you? Why are you doing it? What's your credibility? What's the credibility of the management team? Where's the experience coming from? And if you look at yourself and you look at your management team and go, oh, there's a gap somewhere, there's no harm in telling the investors there's a bit of a gap there, we need the money to fill that gap, or plugging it with an advisor to start with. No startup or scale-up company has everyone there to start with, but trying to lie about it or get around it is not going to help. So you've got just be honest. What is the market opportunity? The customers, what's the competition looking like? Competition is a tough one. I would say in an initial pitch deck, don't spend too long on competition. Everyone says we haven't really got any, and if we have, they're not as good as us. So we expect to see that. And what will happen is the investors in a follow-up meeting will quiz you a bit more on competition and do some due diligence themselves. Actually, this one is one of the ones we don't see enough of. How do you generate income? What's the revenue? What's the margin? What's your forecast look? Investors. How how you're going to get the money in, what pricing model you're looking at, what have you tried. I always say to people when I first coach them, when you do your first round, make sure you're tracking statistics, marketing statistics. What's the cost per acquisition, for instance? Those kinds of things, when you get onto a pitch deck, are fantastic and really valuable. So do try and track as much as you can. How do I know the company can deliver? What's your performance to date? Have you had any trials? What's your future strategy? Have you committed money yourselves? All things that are good to put on a pitch deck. And also, what do you need the money for? How much money do you need? How much is already committed from other investors? Really good stuff to see on a pitch deck. And I guess one of the things I always say to people, what's in it for the investor? Because as I said at the beginning, the angel investor does not have to invest. They do it out of passion. Okay, so you've got to generate that passion for that investor to go, I can't see why I'm not going to invest in this company. I really like it. And always think like that investor. When you're going through any pitch deck, think, if I was an investor, would I be interested in this? So that's kind of pitch decks, and I just wanted to do top 10 tips on things I see and things you really need to be aware of. Let me just have a quick drink, sorry. Timing. Okay, so timing, no one's ever been told off for raising money too early. But if you raise too late, you've got big problems and the valuation will go down. So timing is crucial. Start to look at raising the money probably 6 months before you need it. Okay. Because as I said earlier, you have to get into the networks, you have to start talking to people, and then going through the legal process, etc., can take a long time. So timing is absolutely crucial. First, second round, it doesn't matter. Have a look at that. I did mention this earlier, but practice your pitch. Most angel networks will do your practice with you, but I would say practice in front of people who've never seen your business before. Don't practice in front of your wife or husband who's lived with it for however many years, because they already know about it. You want to get someone really fresh, never seen it before, have a go at pitching to them, because and make sure they're honest. Because there's nothing worse than doing the hard work, getting in front of the angel investors. It's your big time, you've not practiced, and they don't really understand what you do. And because there's a lot of other companies looking for the money, they'll go for the other companies. Okay, this is quite an important one. Don't overvalue your business, okay? Quite often, I will see companies go for a big valuation to start with. And the problem with that is that you might need to do 2 or 3 rounds, and you get to the second round, your business is worth too much, you can't raise money at the post-money valuation, and you have to do a down round because the second lot of investors don't like it. Okay, so you're more likely to get institution and funds come in, and they're very sharp on valuations. So, for instance, if you raise from family and friends, don't put a 10 million, for instance, valuation on your company when, quite frankly, you know within 2 years your company's probably only going to be worth 5 million to an institution. So be careful with valuations. I would be, probably the best thing to do with that is to work out how many rounds you think you're going to need and work your way back, and leave some leeway, because sales won't always go to plan. Okay, forecasts. Forecasts are incredibly difficult when you're in your early stages of business. But the most important thing, and I see this a lot, is making sure that forecast is accurate and realistic, and it relates to your business plan. So if I suddenly see an uptick in revenues or profits in the forecast, I'm going to straight away look at the business plan in that and go, well, why has that suddenly happened? Okay, so if there's no reason for that and you just want the forecast to look great for the investors, So just be a bit careful. Exit. Always discuss exit. You don't need to say what your exit's going to be. No one knows. It's usually a trade sale. It might be an IPO if you're lucky, or depending on what's happening in the markets. But it's important that you discuss exit, because that's the only way these investors are getting their money out. Okay? Just say, I think I might exit for a trade sale in 5 years' time. That's fine. You don't really know, but the investor knows that you've thought about exit. It's in your mindset. Advisory boards. Now, not everyone has an advisory board, and this is where you get outside help from people you might. I really like to see an advisory board. I like to see that the company's gone, I've got a weakness in certain sections, and I've filled those gaps with an advisory board. It might be an entrepreneur who's done it before, who's happy to just help out. You might be short of a finance director. There might be somebody in that advisory board who can help. Very useful to have, and certainly helps when you're doing a pitch deck to have an advisory board there so that your management teams kind of bolt out as well. I did mention this one before, number 7. Admit your business challenges, but convey how you plan to address them. Really crucial. As I said before, everyone has business challenges, but we want you to be honest and just tell us the truth about what they are and how you might handle those. Have a good lawyer, okay? I do see quite often everything goes through smoothly, you've got the investors interested, you get to the legals and you have a bad lawyer who doesn't really know what they're doing, have never done EIS or SEIS investments before, and it just comes to a grinding halt where the lawyers make plenty of money because no one can agree from both sides how the shareholders' agreements or articles of association should look, and they'll argue and keep arguing, and you as the entrepreneur will be stuck because you just want the money in the bank. So I'd say have a good lawyer. There's plenty around, certainly around Oxford and Cambridge that I know quite well. I'm sure in other parts of the next to the wood, but always ask if they've done this type of thing before. It's very important. Put time aside for raising the investment. What I mean by that, it's not quite the same as the first one, which is time. It's you need to know as the CEOs of the business or whoever's doing the fundraising that probably half of your working week will be taken up raising the funds. Okay? So you need to accommodate for running the business, the day-to-day business, while you're doing the fundraising. And the last one, I keep harping on about this. Think like an investor, and you should be successful. Okay. So thanks very much. Okay. Susan.
Thanks very much, Richard. We have got our very own lawyer in the room. So Malin is from Freeze. Freeze are sponsoring this. Freeze are definitely sponsoring this series. Malin will maybe be taking over for me in a minute. What I'd like to do now is introduce Susan Elliott.
I will come back.
And Malin will come back.
I'm here.
Great, thanks very much, Wendy, and good to see you all this evening. And Wendy kindly introduced me as a sort of bonus, but what I wanted to just spend a few minutes for is just to explain a little bit about what the British Business Bank's all about and where it fits in the world that you may live in if you're looking at raising finance. So the British Business Bank is the UK government-owned investment bank, the Economic Development Bank, Business Development Bank, however it is described. And on behalf of government, we're charged with helping break down barriers across the whole of the UK and the devolved nations for businesses seeking finance for growth. And we have right now 3 key themes that we're working with, and one of those is championing sustainable growth. So it's looking at helping businesses manage good growth, you could argue. That might be a best way to describe it. Backing innovation. And we work quite closely with the likes of Innovate UK and some of the other agencies just to help back innovation. And the third one is looking at breaking down barriers. And that might be geographical barriers, it might be sector, it might be gender, ethnicity, whatever it is looking at where those barriers are for people seeking finance, and how can we, on behalf of government, help break down those barriers. So that's the bank itself. My role in the bank, I'm one of the regional managers that covers the southeast. So I cover from Buckinghamshire down to Hampshire and across to Kent, not forgetting the Isle of Wight. That's in my patch too. And it's my job to talk to people like yourselves this evening to raise awareness of what the bank's here to do and how it fits with what you're doing, and also to understand what's happening on the ground and to speak to intermediaries, finance providers, advisors, professionals, the VC community, the business angel community, just to understand exactly what's going on, to help understand where those gaps might be in particular areas of the region. So those are the 2 key parts of the role that I have. In terms of what we're doing, we're not investing directly. So all of ours, you might describe us as a wholesale bank. So we're not investing or lending directly. It's our job to provide the guarantees that sit behind some of the lenders and co-invest alongside private investors to leverage in private investment. So that's the work that we do, both on the debt and the equity side, and that is looking at focusing on particular areas, as I've just mentioned. We also, one of our subsidiary companies is the Startup Loans Company. Benjamin mentioned about debt for early stage and startups. Startup Loans is one of those that does fill that gap. And I think we're just coming up to 10 years of startup loans. And startup loans are available as personal loans into a business of up to £25,000 per business founder. And for some technology, IP-based, innovation-based companies that there might be more than one person that's starting that business, it's worth remembering that up to 4 people in the same business could take out an individual loan for that same business. So suddenly, for a group of people starting a business in tech, innovation, engineering, whatever, there may be availability of up to £100,000. So that looks a bit different at that point. So that's startup loans. The rest of the work that we do is all through about 180 delivery partners. So if you're looking to find out who we work with, they're available on our website, where the commitments are made for the investment and the lending that's through those delivery partners. And finally, just to finish up, part of our key role is to help businesses make the right decisions and understand the options. You've heard some of that this evening. We have a finance hub that has a whole host of resources on there to help understand the different options. That's being added to all the time. We have a cross-cutting theme of helping businesses transition to net zero. And one of the challenges with that decarbonisation, net zero, climate change addressing is some of the terminology, and we have it's called a green decoder, and that's some of the sort of jargon busting. There are lots of different resources available, but we're trying to curate some of that resource. So the Finance Hub, the Green Decoder, we work with the Open University to help put some free courses out there, templates, tools, which come from a place of expertise to help you deliver the forecasts in the right format for the likes of Richard, and to make sure that you're presenting your business and just sort of building your expertise as founders of your businesses. So that's me. I'm Sue Elliott. If anybody would like to have a chat about what we do, I'd love to understand more about what you're experiencing if you're trying to find finance, what's working, what might be not working, and what we could do better, so that I can then feed that back up the chain and ultimately through to government to help make access to finance a bit easier for smaller businesses. So I'll draw a line and pass back to Marlon. Thank you.
Thanks very much. I will have failed miserably on Richard's top 10 things to do. Timing, don't be late. Having travelled 1.5 miles in 50 minutes, I blame the Oxford traffic, but there we are. Thank you to all of our wonderful speakers. Are there any questions either from the floor or from the internet? Here we are, I've got one. Oh, Ron, don't worry. It's punishment.
I do actually have an idea of the answer to this question, but obviously raising funds has a cost, not least legal fees. How would you quantify that, and what would be the best way to forecast that when you're trying to raise money?
Oh, I don't know who that question's for.
Oh, would you like to all go and sit up?
Oh yes, you all take your seats. I'll stand up as the runner / interviewer. Anybody want to?
Yeah, I think
Richard, you have a
it's
view?
worth noting that wherever you go, there's going to be a fee for raising money. It's usually a success fee for raising the money. That usually ranges somewhere between 5 and 8%, whether that's crowdfunding or an angel investment group. Obviously, if it's somebody you know, you won't pay a fee, but usually funds, angel investment networks or crowdfunding, it's somewhere between 5 and 8%. And legal fees, they vary a lot, but usually for earlier stage companies, there's usually a deal to be had because they're hoping that in the future you'll grow and stay with that legal team forever.
Just to add to that legal one, I think you're absolutely right. Having a very open conversation with your lawyers about what you're expecting, what their fees will be, that you don't want a surprise at the end. So just be really clear and really open. And if you don't feel that comfortable relationship where you can ask difficult questions and you get brutally honest answers back, you are probably better off talking to a few until you find that real connection. I mean, you mentioned it earlier about make sure you put time aside to do the investment. I think we mentioned it in our first session. It takes a while to get these transactions away. You have to spend a lot of time with your investors, with your lawyers, with your advisors. Money does definitely come into it, and it's a big part of it. Hopefully the investment will help pay for some of that, but make sure you like the people you are engaging with and that you're talking to as well. That's just as important, I would say.
And I think from a legal point of view, a good lawyer will save you easily the money on the future round, because if they're not an experienced lawyer and you sign up to something in the term sheet, so you don't really know what it means for later rounds, it could cost you a lot in the future. So just bear that in mind as well.
I definitely agree with that. Any more questions?
Benjamin, you spoke about debt funding being typically a no-no for startups. As the company grows and founders become a bit wary about dilution, is there a point in the evolution at which point debt funding becomes more likely to be a good channel?
Yeah, excellent question, and I think actually Susan tempered the point quite well. That was our view on debt as a mainstream bank. Short answer to your question is we usually look at the same metrics of repayability, affordability, and security in early stage, earlier ventures. I don't think there's necessarily a hard and fast rule of, you need to have got to X percentage, but my advice, because I don't give advice, remember, but my advice would be speak to your local bank, whoever that may be, it doesn't have to be us, and just say, look, where do I need to get to before I can obtain some capital?
I haven't got a microphone.
Oh, you haven't got a mic.
Sorry. No, it was just a quick one on behalf of the British Business Bank, because part of our remit is to try to increase the diversity of the types of finance. So going back 10 years, it was very much mainstream banks, high street banks. And if we look now, there is a much broader range of funders, some of the challenger banks and the smaller investment banks. So I think I'm definitely echoing Benjamin's point in just looking at sector focus, if there are some, if you're looking at particular type or level of finance as well, so look around.
And when I mentioned, sorry, it's a very different point to normal debt, but things like RateSetter and SOPA. Sites where ultimately you're asking peer-to-peer lending, not suggesting that's what you want it for, but means you could potentially access some form of lending sooner.
Thank you. Oh God. It's all right. I will. No, I'm fine. Do you want to go first?
Oh, yeah, sure. Thank you for your presentations. Andy Delves, Oxford Business Partners. I've been doing R&D for about 20 years, and I'm going to be in business commercialising it for the next 20 years. And I wondered how you felt about co-investment, because it seems the time horizons are different between angel investors, VCs, and so forth.
I think it's the questions about co-investing with other investors.
No, it's sort of it's really from my point of view, from business point of view.
Yeah.
A venture partner, investment partner, is a great idea. You know, for who wants to be in it for the long term. But it seems to me that angel investors and venture capitalists they'd be wanting an exit in 5 years, essentially. Double their money in 4, probably.
No, I don't think that's necessarily the case. I think 10 is a bit too far. Of course, if you look at returns, you want it to exit as quickly as possible for the highest rate. But there's quite a lot of patient capital around with angel investors, and they all have differing views on it. So some people will be pretty patient. I don't think they'll be patient for 20 years, though. They might be patient for it.
Some like to change the world.
Yeah. I mean, I haven't met any.
I met a lot of. I was talking to one yesterday evening.
It's a nice thing to do. Yeah, and if you're going to change the world, fantastic. They might have that view. What I see with our angel network is kind of the 5 to 10 year horizon.
Yeah, I suppose my question is it an easy thing to do to work with someone who's has a long-term view, and then group of angel investors who are primarily interested in having their money back plus the 10x within 5 years, working together from the beginning? It
doesn't sound like it, because I think you're both on differing paths. You need to be on the same path as your investors, and if those investors want a return in 5 to 10 years, and you say, well, actually, it's going to be 20, they're not going to be very happy. If you've told them at the beginning...
The longer-term investors are comfortable with that, because they know how long it will take.
Right. But I think the question you're asking me is, would the other investors be happy?
Exactly.
Well, no.
So co-investment's not a good idea.
Well, not if their time horizons are 5 years.
I think the point you're trying to make is only if they're all aligned to the same same exit. As long as all of your investors are happy with that time frame, because you don't want pressure within the, some looking to exit sooner, some looking to hold on.
Because you'll just have really bad board meetings where no one agrees.
Thank you.
Hi. I have a question in the area of, so a lot of the requirements in the innovation grant and what a lot of investors like to see is, I mean, innovation itself, you don't really know your market sometimes, So I'm working on haptics, for example. It's an area that's got a lot of interest. It aligns with VR, but it's often difficult to, argue the need for it when there is a market that is heavily investing. Does that make sense? So therefore, you find it very difficult to, because the innovation grant, you've got to have 30%. I think SEIS, you need an investor on board to begin with. So that there doesn't seem to be any sort of enabling grant to kind of help you at that early stage to get, unless you pay from your own pocket, or you've got, to get that 30 grand, if you like, to at least apply for that. Have you got any suggestions on that?
A start up loan, maybe.
That's risky though. Won't you have to start paying that off very soon?
You're right. Right at the beginning, where do you get that finance from? And friends, family, the likes of startup loans, which are soft loans, there are some grants, and I think the earlier stage there may be more percentage that is eligible for grant versus what the match is. But I think it's a difficult time for businesses, and I think that's part of the viability and the realism of anybody's plan as to whether that early stage can then build on that to get that traction and to get other streams of funding. But it's not an easy one, and as Benjamin rightly says, right at the beginning, debt is the affordability of debt, aside from soft loans such as startup loans, are there. It's a difficult place to be, which is why the government has come in and said there's some good ideas out there. We need to put some money behind this, because there's going to be some ones that really succeed within that.
If I can just one sentence on that. From a grant perspective, I don't know the sector specifically, you're working in, but I think Innovate UK have just announced is it £30 million fund for, it's like £15,000 for companies who had never received Innovate UK funding before. It's non-repayable, obviously, full grant. Applications, I think, open in about 2 weeks' time, but it's sector limiting. So you might it's open, is it? Okay, I thought it was July 11th, but somebody knows better, so that's good. But yeah, so I don't know whether it's relevant for you, but it may be something to look at, because £15,000 is non-repayable.
Yeah, that's helpful. You wouldn't have a name for it.
If I had my phone near me, I could.
Fast innovation. It's called fast innovation.
Okay.
Just Innovate UK. Fast innovation.
Cool, yeah. Thank you.
Our last question.
Well, mine's not actually a question, it's more a couple of observations. So I've done a couple of raisings for 2 companies, and I've also got a portfolio of investments as an investor. And a couple of observations I would make is, obviously you need to be able to pitch. The pitch gets you the meeting with the investor, but that meeting is your sales meeting. That, selling and pitching are 2 different things, and I think a lot of people now don't really understand that. And at that meeting, to pick up the point you were making, at that meeting you have to work out what it is that the investor is looking for and whether that matches what you're looking for. So if you're looking for people that want to invest long term, you need to work out whether they're the people that will do that. Because at the point that you have the meeting, what you've done is told them lots about you. You don't know anything about them, and you need to work out whether they're the right people to invest. I mean, for example, my investments are all long-term investments. I'm not expecting them to realise a return for a good few years. And the reason for that is because I think my theory is that one of the ways you get a competitive edge is being willing to invest for the longer term, because most people aren't. But different investors want different things, and I think that's the critical thing to understand, is when you have that initial meeting with the investor, what is it that person's looking for? Why are they investing? What do they expect from you? And how can you match up what you want with what they want? And then the final thing I wanted to say was that the investors, to come back to the presentation at the beginning, the most important thing I look for is a team that will get results. And that's really difficult to judge. And I've been caught out a couple of times where people have thought, oh, they're fantastic, and then they've totally screwed it up and I've lost a load of money or whatever. One of the things I've worked out that really matters is the ability of the CEO and the team to evaluate risk. If they can work out what the risk is that they're taking and how much of a risk they're prepared to take and how they're going to mitigate that and handle that, I always think personally that that's a sign that they know what they're doing, because they're able to evaluate the problems that they're struggling with. If they don't understand the risk that they're taking, if they say, well, this isn't a problem and that's not, it is, people don't vote for that, if you see what I mean. So part of what they're looking for, investors are looking for, is for you to be able to convince them that you can manage the bumps along the road. That's my take.
Thank you. Any other views from the panel on that?
No, I totally
Including
agree.
remarks?
Totally agree with that.
Couldn't agree more. You heard it here first. Thank you again to our wonderful panel of speakers. And thank you all for joining us here today. Can we please thank the panel in the usual way? Before you all go off for the delicious drinks and snacks in the front, please remember that our next meetup is on Thursday the 7th of July, where we will be talking about product market fit, and we look forward to seeing you then. Thanks very much.